Well, hello and welcome to Bloomberg Quint. We're here to wrap the markets for you, and of course we have market expert Ajay Bagga joining us today. But clearly the bears have taken over today, and how, especially when we are expecting muted participation and any absence of any major cues in the last 6 trading days of December, those are left. So the Indian equities touched their 1 month low. In fact, the Nifty gave up that 8,000 mark to end at 7979, the lowest level of course since November 24th. In fact, it was also the first 7-day losing streak that the index, the Nifty and the Sensex both saw for the first time since June 2015, with which Sensex has erased all the 2016 gains. That brings me to the Bloomberg Quint poll of the day question, where we had asked if the Nifty 50 index will clock its 7th straight day of declines, and of course 86% had predicted that it would. But Ajay, what's behind the weakness, and does it really look like the next 6 trading sessions are going to see similar volatility?
Very difficult to say, because I was just chatting with Agam earlier that we used to have a Santa Claus rally, we had a January effect, but last 3-4 years the hedge funds arbitrage it out. So you are expecting the fund managers to go on leave, volumes to decrease, but today volumes are 3 times the average last week's volume. So pretty decent volumes today. Very difficult to call the flows, but what is clear is we are lacking a domestic trigger. Demonetization has met a lesser earnings growth for this quarter. Numbers are not good for all the leading indicators. Nomura came out with a report showing that their indicators are looking at 1996 levels. So overall there's been a fall in cement offtake, in automobile, in textile, in gems, jewelry, retail footfalls, and there is a big liquidity cash crunch in the economy. That's having an impact. And then over all that is the emerging markets to developed markets movement of money, where we are getting our fair share of the money going out.
Agam, cash turnovers have been much lower than the recent average, but as Ajay mentioned, derivatives volumes saw a significant spike.
Yes,
what's happening there? What have you noticed?
Right. So surprisingly, what's happened in the previous couple of sessions is that we were looking at derivatives volumes on the National Stock Exchange at somewhere around 2.5 to 3 lakh crore rupees. Today that spiked to around 5.9 lakh crore rupees. So this may be something of a concern, but we also must not forget that, day before yesterday we had seen substantial build up in open interest when it comes to the Nifty futures as well as the Bank Nifty futures. So this possibly could be one of the impacts which has led to the accumulation we've seen earlier. That said, let's take a look at what's happened in the options market today. With respect to the change in open interest, we're looking at a spike in the 8,000 call, which means that we're looking at writing. So it's unlikely that at least over tomorrow, 8,000 is going to be a resistance. As far as your range is concerned, once again, based on maximum open interest, that still stands between 8,000 and 8,300. But nothing's changed there, and this is exactly what we've been seeing for a few months with the 8,000 level, specifically given the fact that we've seen so much addition in the put open interest. As per a lot of other derivatives analysts also suggest that will remain a viable support zone, but unfortunately we have broken below that now, and this is something of a concern. So well, I'm going to go on and ask you, we're of course moving into January now, and the biggest set of triggers will be the budget. To a certain extent we will see Donald Trump take over, be the president of the United States, and of course we're also going to have a lot of other triggers, such as a lot of data coming in from the demonetization scheme. Based on that, how are you viewing January?
Yeah, January is tough. Overall on the earnings side, Jan 15 the earnings season will start roughly, and you will see pretty poor numbers coming through. Now, if they are not as poor as anticipated, of course the market goes up. What we are expecting is a fiscal stimulus from the government, some pump priming coming into the economy. That's a crying need, but that's wishful thinking. I don't know how much of a fiscal leeway the government has, and what will come through. What we are seeing as a positive is that they've taken a very strong decision, a very strict measure, which has taken a lot of, they have expended a lot of political capital in this demonetization. So will they follow this through with other reforms? And will GST finally get through in the budget session? I think those are a few questions market will look at. In terms of global, I think the dollar rally is overdone. It turns from 104 is my estimate. UBS had a report out yesterday saying the dollar is looking overvalued. So again in oil, I don't think it can cross much above 60 because of the US shale production which comes in around 60. It starts making marginal sense. So I think market is oversold. Market is extremely pessimistic. We have factored in a lot of degrowth in earnings for this quarter and the next. So any positive surprise here, it cracks through and goes through the 8,300, which has become a roof for the market in the last few months.
Alright, that brings me to the Nifty movers. We had just 4 stocks which ended in the green zone. Z Entertainment and Eicher Motors largely unchanged, but clearly the decline was led by metals. So you see Hindalco, you see Tata Steel, and also oil and gas major ONGC. So that really brings me to my next question. Ajay, you already spoke about oil, but metal has been the best performing index in 2016, unlike what anybody would have really forecast or expected. But do you really think there are fundamentals in place, or is there room for more upside when it comes to metals? How are you playing that?
I think it's very difficult, I would say, but we were extremely wrong last year. Nobody thought that materials will do well, except I think Seth Klarman and some of the good hedge funds. They bought oil stocks middle of 2015 at the bottom, and we were all wondering, and he's not made money for last 2 years, and now he's turned around. So metals again will depend a lot on China. China housing is showing some kind of slowdown. If China housing slows down, sell metals and get out. If China continues a stimulus, please go ahead and buy metals. You'll have one more good year. It's as simple an equation as that.
I also want to talk about the pharma sector, because the once defensive sector has somehow lost that tag and undergone a lot of derating. I don't know if you will talk about Sun Pharma per se, but just wanted to understand, it's close to its 2.5 years low, close to 600. Is it looking good as a valuation bet right now?
Yeah, particular stocks I won't be able to talk, but overall pharma, what you have to differentiate is keep out the US focused exporters. I think that they have to go down more, because you've had more than 36 483 cautions into Indian pharma. Look at the players who are serving more of the domestic market. Domestic growth is more than 15%. Valuations are good. You have some names there. But the generic players, there's one thing that will come, that the kind of, if Obamacare goes, as they have been talking, or gets modified and they go for cheaper medicines, our players get a benefit. But FDA is very worried that India, being the second biggest repository of FDA approved plants outside US, and seeing plant after plant having problems, I think you're going to see more action by FDA. Second is the antitrust case in the US. I think that is still not baked in, except for a couple of players whose name came in. That can expand across states, across companies, across products. It can expand much more next year. So I would say stay away from pharma in a nutshell. Very little triggers and too much headwinds on the regulatory side to really be able to take a decent valuation.
So all of 2015, everybody was talking about increasing exposure to pharma stocks which have a higher US presence now, and of course now it's reversed, because now you're saying we should start focusing on the domestic market. So all your domestic market drug price control related issues you think are really sort of tapering off, and now this is looking more favorable.
It is tapering off, plus the domestic consumption story, and you are seeing 15% year-on-year growth in the domestic pharma side. So we are focusing more on players that get a large chunk from the Indian market, or say an African market, which is still not come under so much of a cloud. US is the biggest market, and along with Japan, very attractive, difficult to break in, and somehow very irresponsibly our pharma guys have not spent on those compliances. You don't get to hear a multinational pharma getting an FDA 483. Why is that? They have those compliances, they are spending on that. Go ahead and spend. You're making huge margins, but people are not willing to spend, and we are getting such stupid comments as data integrity issues, or you have not kept the test results in a proper manner, or the ceilings are leaking, or the toilets are unclean. I think all these could be sorted out very easily, and it's a shame it's been 4 quarters and we are still getting these kind of commentaries from the FTA.
Right. Agam, mid caps cracked a lot more significantly. Any movers that you're going to take us through?
Yes, so in the broader markets, we're looking at 1 gainer as against 7 losers. This is, of course, as far as the Nifty 500 is concerned in the broader market. So let me take you through some of the losers right now. We have Swan Energy, of course. It keeps swinging in and out of the red and the green zone, but currently losing as much as 6.8%, followed by Motilal Oswal. And remember, a lot of these broking stocks were gaining yesterday. Motilal Oswal, of course, looking at some kind of profit taking today, followed by GMT Auto and Indian Bank, Kalpataru Power, as well as Orient Cement losing out as much as 5% in today's day of trade. And in gainers, we have Infibeam Corporation, BEML, Berger Paints, as well as Welspun Corp, followed by Shriram City. All of these gaining to a certain extent, but the momentum for now is clearly towards the losers. And one sector that stands out, or the subsector that stands out, is the PSU bank, Shraddha, and I'm sure you would like to ask here, Ajay, about that.
Yes, totally. So, Ajay, in the immediate aftermath of demonetization, that was one sector which saw a fantastic rally, but after that it sort of tapered off and cooled off. So, I'm just trying to understand, was the initial treasury gain related optimism, has it now turned into the focus on NPAs and recoveries and the status quo that was maintained by RBI?
Spot on. 3 things going against PSU banks. One, the treasury gains did not materialize. A lot of the market was factoring in a rate cut by RBI. That didn't come in. You see the 10-year treasuries, how they have reacted. Second, the CRR that the RBI imposed, that has put about 1,000 crores hit onto and largely on public sector banks. The third part is there's just been no time to look at NPAs and fresh dispersal. So 66,000 crores the debt book has come down in the last quarter, while the NPAs are not reducing. Secondly, 16% of the book is SME, 24% of the book is farm related. Both sectors really suffering with demonetization. So you will see the NPA flow through increasing. That is what the market is anticipating. So very little in a positive trigger for the public sector banks. Valuation wise looking good, but we are searching for a positive trigger. And then there is a political overhang like on the MFIs. Even here with Punjab elections, UP elections, will there be a clamor for farm loan waiver? Which again, there will be a lag between a write-off and the government recapitalizing. I think market is a little spooked by that as well.
So again in the PSU bank versus private bank debate, if you're talking about 2017, what would your preference be?
Private sector banks.
Clearly private sector banks.
Clearly. A couple of public sector banks, yes, but overall, you need to have lesser public sector banks. You need to do a lot of mergers, take a lot of cost outs, bring in a lot of productivity. Plus, there's a lot of cleaning that needs to be done. If you see the stressed assets, which is the GPA plus the SDRs and all the CDRs, is 16.5%. So 1/6 of your asset base is stressed.
Right.
And you're not able to lend afresh. Second, the economic growth in the economy is not there. So what will lead this economy further will be again consumption, will be again driven by the consumer finance guys. So private sector banks are much better positioned there. They'll come out faster.
So in a related question, actually, I also wanted to ask you about NBFCs, in this case specifically the microfinance companies. And we know that, they had gained substantially. At one point in time, they were extremely overpriced, but we have also seen a correction now. How would you play this space?
See, again, market was factoring in that multiple years you will have 30% year-on-year growth in these books. The books were not seasoned. They're not seen a full credit cycle. Right. A lot of the book, especially on the domestic NBFCs, was loan against property. whereby the rates were more or less similar, services are similar. What was differing was the amount of valuation you were willing to give to these. And especially in North India, there was already stress before demonetization. Now that stress will come in much faster. MFIs, the best they are talking is 91% collection efficiency. You are talking 7-8% shortfalls. On top of that, Maharashtra, UP, not very good political sounds coming through. We've seen that in Andhra in 2010. If that comes in, then what happens is, because it's a very close-knit community, and two people get away by not paying, the whole community stops paying. And you have thousands of crores of write-offs. That's what's spooking the market. So no need to be brave. Let this play out. You're not going to see them running away 20% up. You will catch the same prices maybe 3 months down the line. Not 3 years, slip of the tongue. 3 months, you will probably get the same MFI prices. So no rush in getting it. You have better options. I think private sector banks, which are more broad-based, I think that those will be better.
And finally, I know that you can't talk about stocks, but are there any pockets in the markets, maybe different parts of sectors where you see now there is a chance, there's an opportunity that you may want to get into right now, or maybe in the next few weeks whenever it arises?
I think next few weeks, because I see the market going down a little more. Unless there's a strong pre-budget rally by around Jan 15, 16 when the budget session starts. I think till then, or Jan 2nd at Lucknow, Prime Minister Modi announces some SOPs. So that could rally the market. Those are the two catalysts. Trump comes in Jan 20th. What you could play pre that, if IT goes down more, go out and buy more IT. Because there's no way you don't have enough people in the US of that skill set to replace the H1B visas. Outsourcing you can't replace. At this cost, you are not going to get that kind of work done in the US. No matter how much artificial intelligence, blah, blah, that you hear. So IT, I think, has been hit inordinately. That's a contra call. Cement will go down further. Fuel costs are going up and volumes will fall off. So cement is in a grip of pessimism. Wait for a month, you'll get good, even better prices than this, and then go ahead and load up on cement. Because as the government spends on infra, as real estate comes back, cement will lead, and that's safer than metal. Coming back to your point, because metals is so linked to China. Out of 1600 million tons of steel, China produces 880. We produce 89. So who moves? China moves the market, be it aluminium, be it copper, be it steel. So that is too much of a China play, but cement is local, and as the economy picks up, cement will give you good returns. We had 2 years of good returns, 3 months of very sharp corrections, 20 to 50% kind of corrections. Little more will come. Maybe around Jan 15, 20th, you can look at cement.
Well, I hope that you guys have got a lot of ideas from our conversation with Ajay here. And this is also what we have so far with respect to the market wrap today. Thank you. And for more news and updates, well, before that, I'd like to thank you, Ajay, for joining us and taking us through some of those questions. But yes, you guys can always stay tuned into Bloomberg Quint and also visit us on bloombergquint.com for more news and updates. And until then, it's goodbye.